Welcome, everyone. This is going to be a Patreon exclusive, episode 103, I believe. This one's going to be all about valuation. And this is a very deep subject with lots of opinions, lots to learn about valuation. So what I plan on doing is instead of just going over my personal favorite way to value companies, I want to go over valuation as a whole, what I think about lots of different forms of valuation, what I disagree and what I agree with other investors and what they do with valuation, and try to learn about this subject as if you're a complete beginner. So if you're brand new to investing and you're thinking, I don't really know how to value a company, Joseph, I don't know how to look at a company and know what to pay for it, right? That's things that we can solve. That's something that you can learn. You can learn how to value a company, and you can really learn the intrinsic value of a company, meaning if you had no stock price, if there's no market cap attached to it, we could look at just the fundamentals of the company, the cash flows and the revenue and the earnings of the company, and we could know what to pay for it without the market giving us any indicator. That's what valuation is. Learning what a company is worth so that you can buy it at a fair price or hopefully at an undervalued price when the market sells out of something and you can buy it for less than it's actually worth. Now, having said that, let's go ahead and jump in here. First with an example, and I'll pick Texas Roadhouse, but you could equally apply this to any company. So we bring up Texas Roadhouse, TXRH in Qualtrim. The first thing I'd like to mention is that many new investors, they look at the share price of a company. The share price of the company has almost nothing to do with the value or valuation of the company. And many people, especially brand new ones, if you're brand new to investing, you get confused about the share price because you're not factoring in how the share price is calculated. For example, Texas Roadhouse right now has a share price of $100.02 per share. That's the share price today. We look at Microsoft. Microsoft has a share price of $242. So a novice investor might look at this and go, wow, is Microsoft really 2.42 times more expensive than Texas Roadhouse? Because Texas Roadhouse was $100 per share, Microsoft is $242. So Microsoft is 2.4 times more expensive than Texas Roadhouse. That's not the case at all, because what that doesn't factor in is the amount of shares outstanding. If we go down to some charts here and we look at the shares outstanding, Microsoft currently has 7.45 billion shares outstanding. Then we look at Texas Roadhouse, and Texas Roadhouse has, let's take a look here, 66 million. So even though Microsoft shares are only 2.5 times more expensive, they have 7 billion more shares outstanding. And that's why Microsoft is at a market cap of 1.5 trillion, while the market cap of Texas Roadhouse is only 6 billion. So that's the first thing. If you're brand new to investing, you can basically ignore the share price in your valuations. Just erase it. Don't even bother with the share price. You can come to the fair value of the company without even looking at the share price. So that's the first thing. The next thing that you would want to do if you're trying to value a company is you look at the options available to you, and you can value companies in multiple ways. What I've done in Qualtrim is instead of try to force one way of valuing a company upon you, I've given lots of different options, the most popular ones, the most used ones, and I think the most useful ones. For example, we have the market cap of the company right here. That's literally all the shares outstanding multiplied by the share price, which gives you the market cap. And the way that you can think of the market cap of the company is, let's say that I had $10 billion. I was very wealthy. I had $10 billion. Do I think it would be worth it to buy Texas Roadhouse for $6.6 billion of my $10 billion? That's how you should view buying a stock, is look at the total price of it and look at what you're actually paying when you buy the stock. And that changes your perception a little bit. So we have the market cap of the company. That shows you the total price of the entire firm. Then we have the most commonly used valuation metric called the PE ratio, the price to earnings ratio. What this is you take a multiple over the earnings of the company. So every company has something called earnings per share. Right here we have that in Qualtrim. I can look at this annually. We have the earnings per share. And like last year, it was $3.50. So if you buy Texas Roadhouse at $100 per share, and the company does $3.50 of earnings per share, then you are paying a 25 times multiple on last year's earnings per share. And right here, this means trailing 12 months. So the trailing 12 months, you're paying 25.7 times what it earned over the past 12 months. But most of the time, you want to value a company based on the next 12 months earnings. Analysts work really hard to do analysis on how much the company's likely to earn over the next 12 months. And most of the time, they're usually accurate. They can be off sometimes, but I think the analysts really do a decent job showing up with a consensus of what the company's likely to earn. And typically, if it's a good company that's growing earnings like Texas Roadhouse, the earnings per share looking forward will be lower than the earnings per share looking backwards, because Texas Roadhouse is expected to grow earnings by a certain amount, right? By 15, 20%. So this is the forward earnings, the price of the company based on what it's expected to earn over the next 12 months. Now, PE ratio is often the shorthand way of valuing companies. It's used so much, and I think that it has dramatically incorrect ways that people are using it. I think people draw incorrect conclusions many times by using the company, or by valuing the company this way. For example, Texas Roadhouse has a 20 forward PE ratio. We can go to a different company, like Ford. Ford has a 7 forward PE ratio. So if you're an investor and you're looking at valuations, you might instantly think that Ford is a cheaper company than Texas Roadhouse. And that is true based off next year's expected earnings. But there's specific reasons that certain companies trade at different PE ratios. And that's where this gets a little bit more complicated. The one thing that investors leave out in PE ratio, or there's actually two things that they leave out in PE ratio, two critical parts of valuing a company with the PE ratio is the returns on capital employed and the growth rate of the company. Those are two important variables. And if you leave those out, you can't accurately draw conclusions of what a company's PE ratio should be. I'm going to leave this in the description, but this is I think this is just an awesome piece of research by Michael Malbison. He's a researcher for Morgan Stanley now. He writes all these different articles, and he has one's called, What Does the Price to Earnings Multiple Mean? And he goes over how people basically compare apples and oranges. Companies like Ford against companies like Google and the PE ratios between the two. And again, what he recommends is that you look at two different things when assessing the PE ratio. On page 14, rather it's somewhere around here. Let me try to find it. There we go. It is page 10. So on page 10, he has this nice chart here. And this matrix chart really gives us what he's talking about. So given different scenarios of ROIC, which is very similar to the returns on capital employed, it's just another way of measuring very similar things. Basically how much the company earns based on how much money it has. This gives you different valuation metrics based on these two different inputs. So we have the returns on capital employed, the returns on invested capital in this case, of 4%, 8%, 16%, and 24%. The higher this metric is of a company, and the faster the earnings growth, the higher the PE ratio is justified. So in the case of Ford, the reason that that company trades at a 7, remember, it was at a 7 Ford PE ratio, is because the returns on invested capital of car companies are very unpredictable and typically persistently low. So when you actually factor in that variable of returns on invested capital, it makes sense for Ford to trade at a 7 PE ratio. It's appropriate. Moreover, Ford is not an earnings growth company that just grows earnings year after year after year. So the fact that it has low returns on invested capital and it has slow earnings growth means that it has justifiably a lower PE ratio. And this is why I think that so many investors use the PE ratio incorrectly. They apply it incorrectly. They're comparing apples to oranges day in and day out. The good thing for us is the fact that so many people use this metric incorrectly means that there's inefficiencies in the market. It means that others make mistakes that we can benefit from. So if you become enlightened, if you actually learn about this stuff, you have an edge over every other investor that doesn't know about them. So that's why I focus on this chart. When I look at PE ratios, I look at the returns on capital employed of a company. I can go down here and look at the ratios chart here right on Qualtrim, and I can see that the returns on capital employed last year was 16%. well above the cost of capital of 8%. So Texas Roadhouse is taking money at 8%, and then they're investing it and getting 16% returns. It's pretty good. That means that the company, deservedly has a higher PE ratio than a company that has 4% returns on capital employed. We can also look at the growth of the company. If the company has high returns on capital employed, it's good for them to have fast earnings growth. And in this case, Texas Roadhouse has very fast earnings growth. In the last 10 years, the past decade, they've grown it at 15% year over year. So they're fast growing and they have decently high returns on capital employed. That's why Texas Roadhouse trades at a higher PE than a company like Ford. So with the PE ratio, what I'll say in summary is obviously the cheaper you can buy any great company, the better. So if Texas Roadhouse goes from a 25 PE ratio to a 20, I'm happier to own the company. If it goes from a 20 to a 17, I'm even happier to own the company in that case, because it means that less is being baked into the price. I'm buying it at a cheaper deal. But it's imperative. It is imperative that when you're doing analysis on companies using PE ratios, that you factor in the returns a company gets and the growth rate of the company. If you don't factor these in, then you're basically comparing apples to oranges and you're going to draw very incorrect conclusions. PE ratio is not my favorite way to value a company, but I do use it from time to time when I'm valuing companies that are very similar with their economics. Moving on, we have the next way in Qualtrim to value a company called price to sales. So all of these are multiples over different metrics. The price to earnings is the multiple of the share price over next year's earnings or the prior 12 months earnings. Price to sales is the same multiple, but instead of over earnings, it's over the revenue of the company. So you're basically saying, how much is this company compared to its actual revenue? And in this case, the price to sales over the past 12 months for Texas Roadhouse is 1.7. So you're not paying much of a multiple. You're paying 1.7 times the company's 1 year revenues. So you look at the amount that the company revenues in a year, they revenue around 3.46 billion, or they did over the past 12 months or whatever. And then you're paying about 2 times that much, 6.61 billion. So that's a 1.7 price to sales. You could replace this with price to revenue, and PE you could replace with price to EPS. So price to sales, 1.7 times. What I want to say about this metric in particular, price to sales, is that I think that it is amongst the most, I don't want to say entirely useless, but I think it's one of the most, it's not one that I like. It's one of my least favorite valuation metrics because sales are not profits. A company's worth the cash flow it produces that's actual profits that can be returned back to the shareholder. Free cash flow. That's what you actually get as a shareholder. And knowing the price to sales, knowing the revenue of a company tells you nothing. And frankly, there's lots of companies that their revenue is so completely different that valuing a company based off of revenue tells you really little. For example, if you look at Walmart that has razor thin margins, it's going to trade at naturally a very low price to sales because the margins are low. You have a company like Microsoft, it's going to trade at a much higher price to sales because it has much better margins. So if you're looking at price to sales, what you have to factor in to make this one where you're not comparing it apples to oranges is the margins of the company. They have to have similar margins. If you're comparing price to sales of one company to another, compare the margins as well. If you don't compare the margins, this is completely useless. It just means nothing. So see how all of these quick valuation metrics are totally reliant on other pieces of data? PE ratio is reliant on the speed of growth and the returns the company gets on capital employed. Price to sales is reliant on the margins of the company. If they don't have similar margins in the price to sales, they're not comparable. They both are reliant on other pieces of data. And many people, again, they compare companies that should not be compared. They use price to sales to compare different companies that have different margins, and they use PE ratios to compare different companies that have different levels of earnings growth and different historical returns on capital employed. If you can, as an investor, be disciplined enough to add in the other pivotal data, like the margins of the company and the returns on capital employed and growth rate when you're comparing PE, then you have a leg up over most investors. But again, overall, out of all these different forms of valuation, I just have to mention price to sales is my least favorite. I've kind of not used it. I just don't use it that often. I don't like it. I don't think it's that useful. Even when you factor in margins, I just think there's so many better ways to compare companies. I keep it on Qualtrim because it is common. Some people use it. And sometimes it's funny to highlight astronomically overvalued companies. Like if a company's trading at 30 times its revenue, that means it's dramatically overvalued. Anyways, moving on from price to sales, we have another one, EV to Ebitda. This is another one that I think is helpful, especially for companies where it's difficult to look at their cash flows because they're doing so many big investments. Like Amazon, for example, is one that I'd use EV to Ebitda to value. But this is another one. You're looking at the enterprise value of the company, which is basically the entire market cap versus the debt. It's as if you wanted to buy out the entire company, and you're comparing that against their EBITDA over the trailing 12 months. So it's another simple multiple. This one I actually think is more useful than price to sales because sales is not a profitability metric. It is just total revenue. EBITDA is a profitability metric. So I'd prefer valuing companies based off of profitability metrics over sales metrics. Any day of the week, I'd rather use this one than this one. But this still isn't my favorite one. Next up, we have price to book. This is one where you're looking at the book value of a company, which is basically like if you were to tear down everything and kind of get rid of all the brand value and intangible assets, how much would the company actually be worth? This one can be incredibly misleading because a lot of times when companies do buybacks and they shrink their share count, and companies that have so much value with their brand and their operations and cash flow, but they don't have a lot of physical assets, those companies will have insanely low price to book values. Here's an example of that. We have Home Depot. Home Depot doesn't really own property. They don't own real estate. They don't have a lot of assets. They just run a retail business where it's basically what they have is their method of doing things. They have their logistics. They have all their locations that they rent. They have their brand name. They have all of their employees, right? So it's a phenomenal business. Home Depot is a great business, but you look at the price to book and it looks silly. It's at 261 times. And the reason why is, again, because if you were to actually strip away all the intangible assets from Home Depot, it makes the company look like it's not worth much. And this is why I think that price to book should not be used for most companies. The place that I think price to book is actually helpful is banks. When you're valuing banks, it's the key metric I look at. Because banks are all about their balance sheet, their book value. I look at the price to book when I'm valuing JP Morgan. If this goes down to a 1.1 or below, I get really tempted to buy the company. That's the point where I'd want to buy in. If it went above a 1.8, that's kind of where I'd be selling it. So you can look at the price of the book value of a bank, and that is basically what you're buying when you buy a bank. You're buying their balance sheet, you're buying their exposure. So that's the one case I really use price to book. In most cases, I do not use it. Now, finally, we get to the last one here. And this one is by far my favorite. I've grown to love this valuation metric, and it's the free cash flow yield, the free cash flow yield of the company. Why do I like free cash flow yield so much? Because at the end of the day, what you're buying when you buy a company or any asset, whether it's a bond, a company, a rental property, anything that you're investing in it for cash. You're investing in it for free cash flow. And the free cash flow yield is the yield of that free cash flow currently. So you can see right at the bottom line, the thing that we're looking to get, which is cash flow, we get to see the current yield right now of the cash flows this company provides. And when you look at the free cash flow yield of a company, this gives you an indication of expectations the company has. In general, the lower the free cash flow yield the company has, the more expensive the company is. That means that the company must have really high expectations. Like if it has a 1% free cash flow yield, that means it's awfully expensive. Either it's just really overvalued or investors are expecting a large amount of free cash flow growth in the future. That means that there's high assumptions baked into the stock price. On the contrary, you have companies that have higher free cash flow yields, like Texas Roadhouse, 4.17%. That's a very healthy, juicy free cash flow yield. That means that they have very low expectations for this type of company. And then you have other companies that you have even lower expectations that have 8, 10, 12% free cash flow yields. If a company has like a 20% free cash flow yield, that means that basically in the future, investors are expecting that the company's cash flows go down. They don't grow. They go down a lot. So that's the yield of the company based off of its free cash flow. To calculate this number, if you were to actually calculate this percentage, the formula is pretty simple. What you'd do is you'd go to this chart here, the free cash flow per share here on Qualtrim. You take the previous 4 quarters, so I can see it right here, 1, 2, 3, 4 of the free cash flow per share. You add all of this together, and then you divide it by the share count. And that's how you get the free cash flow yield of the company. So it's literally the free cash flow per share divided by the share count. Now, again, this is my favorite one. I use it all the time in valuation. And basically what I'm doing when I look at all of my companies is I'm trying to do 2 things. I'm trying to look and see what the company's free cash flow yield should be based on the qualities of the company and my projected growth rate of the free cash flow. Then I'm trying to actually do analysis on what that projected cash flow will be. I look at the trailing 12 months, I project out what it will be this next year, and then I try to determine how likely it is to grow at certain rates over the next 10 years. And that's where analysis and understanding of the company comes into play. For example, I look at a company like Texas Roadhouse here, and the first thing that I notice is that it has a free cash flow yield of 4.17% based on the trailing 12 months. In my opinion, this is a healthy yield. I think it's a little bit above the norm. And so Texas Roadhouse is not a super expensive company, in my opinion. The 10-year treasury is at like 3.5%. So you could buy the 10-year treasury and get your nice risk-free 3.5%. The S&P 500 yield right now is around 3.4%. So you could buy that around the same, or you could buy Texas Roadhouse at 4.17. So you have different yields of cash flow that you can get. You can get cash from the 10-year treasury, you can get it from the S&P 500, or you could buy whatever company you're looking at. And that's the starting yield of all of them. Once you've established this starting point, what I do then is, again, I look at what I think it will be next year and what I think this company is going to be able to do for the next 10 years. And that is the difficult part in analysis, looking on a multi-year basis. With Texas Roadhouse, what I look at here is a company that has this healthy starting yield, and I was buying the company heavily when it was closer to a 5% yield. I thought it was very undervalued at the time. So it's come up a little bit now, but I look at the company and I just do some basic analysis on the type of risks the company faces, the cyclicality, the management team. I think the downside risk, the use of free cash flow, what they do with their actual cash flows when they earn it, the runway of growth, how many restaurants can this company open in total in its lifetime, how many will it open year by year, right? I do all this analysis simply to try to project out the future. When I look at this company, I see one that's very experienced in the restaurant industry. They ran the company for over 20 years, very successfully. It has low amounts of cyclicality. It has a revenue growth rate of about 10 to 12% over the past decade. So 10 to 12% revenue growth. And then I look at the cash flow growth, and they've been able to grow their free cash flow at a rate of 17% CAGR over the past decade. So their cash flow growth is actually exceeding their revenue growth. And they do that, they can do that for a lot of different reasons. If I look at the free cash flow per share growth, this is growing at an even faster speed, which means this company is doing some good things. They're making it so that the free cash flow I earn per share that I own is going higher and higher over time. Over the past 10 years, Texas Roadhouse has grown their free cash flow per share at an astounding rate, 17% compound annual growth rate. And they've done that while paying a hefty dividend. So the company is really doing a good job of growing. My expectations are this company can grow its free cash flow per share over the next decade in the mid-teens rate. So 13, 14, 15%, I think they'll be able to do that. If that's the case, I think this company will outperform the S&P 500 by a very large margin because it has a higher starting yield with a higher growth rate. I think it will multiply 1 to 2 times. I'd say 2 to 3 times actually over the next 10 years. So that's the way that I look at it. And that's a very simple way to look at valuing a company like this. Looking at the starting yield of the company, doing analysis on your long-term projections of the company, and then trying to see the risks associated with it. And if you really think the company can grow at 15% or 10% per year, you have a very good chance of beating the S&P 500. But a lot of that comes back to the qualitative analysis and the amount of risks facing companies. Because if some other steakhouse opens and they steal all the butchers from Texas Roadhouse, and they steal all of their cooks and their servers, if they really run a good competitive thing against them, that's what can disrupt your company. So you're trying to buy companies that not only can they grow their free cash flow, but they can do it safely without taking on too much risk. A lot of investors forget that it's a competitive world. There's many other companies trying to always take market share from the investments you're making. There's always competitors out there trying to take what these great companies have. So you have to have companies that have a moat that can defend themselves. Now, in terms of the valuation metrics, I'd say that this is kind of a shorthand way of valuing all of these companies. There's far more complex ways of doing this. One of them is discounted cash flow. Now, I don't want to mistake the term here. Discounted cash flow analysis is basically what I just did with the free cash flow yield. Looking at the company, trying to project how much money it will make in cash over the next 10 years, and then trying to find an appropriate discount rate to apply to that based on opportunity cost, like I brought up with the 10-year in the S&P 500. That's discounted cash flow. I just did a discounted cash flow analysis. So don't make the mistake of thinking that discounted cash flow analysis is only when you have a spreadsheet. A lot of people think that. They think the only way it's discounted cash flow analysis is if you have a spreadsheet. And if you don't have that, it's something different. No, anytime you're looking at a company and mapping out the future cash flows and then discounting it based on opportunity cost, you are doing discounted cash flow analysis, whether you're using a spreadsheet or not. There's many investors like Charlie Munger has said he's never seen Warren Buffett use a spreadsheet, but Warren Buffett certainly does discounted cash flows. He probably just does them in his head. There's a spreadsheet version of doing this as well. And I have done this for basically every company that I'm invested in, almost all of them. I'll give you an example of Texas Roadhouse here. Let me zoom in enough that you can see this. I think that looks good. All right, so we have Texas Roadhouse here, and I'll share this spreadsheet with any of you. You can use it as well. Here's how I do the discounted cash flow if you want to have a more formal way to value this company. The ticker here, you put in the ticker symbol. The discount rate is kind of like the opportunity cost. So I'll make the assumption that right now, the opportunity cost is the S&P 500, and I threw in 8%. Why did I choose 8%? Because I think that's a good hurdle to beat. If you're beating 8% per year, I think you're going to be doing just fine. And in most cases, you want to beat that by a sizable amount, but I think 8% is a decent amount. A lot of analysis right now, like a lot of economists, believe that the S&P 500 is not going to do great over the next 10 years. I think it's going to have pretty abysmal performance, like 4 or 5%. So I put it as 8%. I think that's a good hurdle, a good discount rate. You can alter that as much as you want as well. And then we have some assumptions we're making for the company. And we try to inform these assumptions based on as good of data as possible. What I do is I look at the revenue of the company and I project what I think the average compound annual growth rate will be over the next decade. That's the revenue. In the case of Texas Roadhouse, the company has grown consistently for 2 decades at a rate of 10% or a little bit over 10% per year. They did it at 12% over the past decade. Now, I look at the company and I look at their earnings report, I look at their business, and I know that the company has a few tools to be able to grow revenue. One of them is they actually open up more restaurants, 25 new restaurants per year. They're franchising some other brands as well that they're opening up. So that's one way that they grow revenue. Let's say that makes up maybe 3% of revenue per year is additional restaurants. Then they have another way that they grow revenue through, they do what's called price hikes. So every year they're increasing the prices a little bit. Let's say that that's like another 3 or 4%. All right, so we're up to about 7% revenue growth, 3 or 4% from price hikes, 3 or 4% from new restaurants. Then Texas Roadhouses, they tend to do better every year. They get more customers. So even with the price hikes, they have more customers year after year after year. So like a Texas Roadhouse location that's open for 6 months, it'll be busy, but it might not be packed. One that's open for 3 years is probably packed. A lot of people go to it. So that might be another 3 or 4%. So you have different ways that they grow the revenue, and they can get to that around 10 to 12% per year. And that's the assumption I'm making, that they can do that pretty reasonably over the next decade. So with that informed decision, based off of my analysis, I try to say that they're going to grow revenue at 10%. Now, a lot of times investors do this, and I don't like when they do this. They say, you know what, I want a margin of safety. So I'm going to assume they grow it at 6% because I demand a big margin of safety. I don't think that investors should do that. I think that you should try to be accurate. Aim for accuracy. That should be the goal. Your discounted cash flows should try to aim for accuracy. If you want a margin of safety, then aim for accuracy with your assumptions and buy the company for a cheaper price than what your assumptions are. That's how you get your margin of safety. But what you should be going for all the time when you're making these assumptions is not aggressive growth, not aggressive assumptions, but also not conservative ones. You should be going for accurate assumptions. So then when you look back on your discounted cash flows, you can be saying, when I made this, I was going for accuracy. The next thing that we look at is informing our decision on the EBITDA margin of the company. And the way that we do this is very simple. The spreadsheet actually calculates this. So we have revenue right here. What I do is I take the last year's revenue. I actually added up the last 4 quarters of revenue. So I added up this one, this one, this one, and this one. Last 12 months of revenue. And then I plug that in right here. $3,900,000,000 is the last 12 months of revenue. Then I also added up the last 12 months of EBITDA. Okay. And then I plug that number in right here. $443 million of EBITDA over the trailing 12 months. And this number right here is the margin of revenue to EBITDA. And I used that same margin, assuming no expansion of margin. It's about 12% right now. I think it will just stay around 12%. So I'm not making any assumptions that Texas Roadhouse could grow their margins. Now, could they? They might. They're trying to do some licensing agreements and do some franchises, which would certainly grow their margins if they're successful at that. But that's way too far out. I don't think that's certain. So in trying to be the most accurate, I think 12% it's a pretty good assumption. I think it will be a pretty accurate assumption. It's a restaurant. I can't imagine them growing margins up to like 15% from 12% in a decade. Maybe they could, but I think is a very dangerous assumption to make. So I'm going to do 12% right there. Just assume that it's flat. I think that gives us a very safe assumption on it. We have the CapEx margin here. This one's very easy. What you do is you take the last 12 months of revenue and you find the percentage that CapEx makes up of that revenue. So I'd take 200 million and divide that by the number right here, 3.9 billion. And then you move the decimal space 2 spaces, and then you have 5% right there, which means out of the revenue the company takes in, they spend 5% of their total revenue opening up new locations, buying new, building these new Texas Roadhouse locations. I think they take about $5 million per location. Maybe it's gone up a little bit with construction costs, so like 5 to 7 million. To build the nice Texas Roadhouse restaurants, they have to pay for that. So that's where this 5% CapEx margin is. There you have your assumptions. Then what this spreadsheet actually does is it projects out the cash flows over the next 10 years like a bond. Like if you're going to buy a treasury bond, you know how much money it would pay you every year. This is what it does. It projects out these cash flows, and you have the margins. Right here, this top line, we have the revenue. If it grows at 10%, it goes from 3.9 billion to 4.3 billion, 4.7 billion, 5.2, so on and so forth. In 2032, Texas Roadhouse will be doing $10.1 billion in revenue per year. The next line is the EBITDA. The EBITDA at 10.1 billion, because we kept the same margin, it will be $1.2 billion of EBITDA. Then we factor in taxes. Every company has to pay taxes, so we're bringing back the taxes, and the taxes will be 506 million. Or sorry, this is the capital expenditures. The CapEx right here will be 506 million. We're expecting 5% CapEx margins. Then we factor in the taxes right here. So looking at this, we have the taxes. And I didn't want to get too nitpicky with the taxes and change it based on every single company I'm doing analysis on. What I did was I looked up, generally speaking, what companies are paying, and they're around 14%. So I put 14% right here, which is right around what Texas Roadhouse is paying in taxes. I'm just going to assume that stays the same over the next 10 years. And we have $170 million in taxes that they pay. Then, based off the discount rate that you put in, what it does is, since money today is worth more than money 10 years from now, you have to discount the money that's 10 years down the road. And this discount factor, you can see it makes the cash flows worth a little bit less every single year because there's opportunity cost. So the 1 year from now, the money's worth 93%. 2 years from now, it's worth 86%. 3 years from now, it's worth 79, so on and so forth. And then at the end of 10 years, the cash flow that's 10 years down the road is only worth 46% of what it would be today. Because 10 years is a long time to be able to wait for that cash flow. That's the discount factor. It values the time value of money. There's value in having money right now because you have so many other opportunities. This cash flow that you're earning 10 years down the road from Texas Roadhouse, you could invest that into a treasury bond right now and earn 3%, right? So that's why you discount it. Now, what it does is it has a terminal value multiplier, which basically means after the end of these 10 years, we just give a really basic assumption of what the lifetime value of the enterprise will be, what the firm will be. And then we have the fair value and market cap of the company. Based on these assumptions, we have a company right now that the current stock price is $100. And based off of what I think the company's worth today on this discounted cash flow analysis, I think it's worth about $126. So, $125. Now, even before I did this discounted cash flow, I did this one actually this weekend. When I was looking at Texas Roadhouse and looking at the yield of the company and what I think the cash flows were worth, I remember a few months ago, maybe 3 or 4 months ago, I came out with my fair value analysis on it, and I thought it was worth $125. That's what I think the company's worth. So the discounted cash flow really mirrors that. Now I can look at the company and I can say, look, it's trading at $100. I think it's worth about $125 based on these assumptions, and I have myself a nice price target. Maybe I want to buy this company only when it's trading 20% below its fair value as a margin of safety. So right now it's trading 27% below. That way, if I'm off on my assumptions and they might be a little too aggressive, I give myself a margin of safety. So I think the margin of safety should not be applied in your presumptions. That's not where you give yourself a margin of safety. You aim for accuracy with your assumptions. You aim for the margin of safety with the upside and downside, buying the company. You think this is an accurate assumption, but I want a margin of safety, so I'm going to buy the company 20% below what my estimate is of its fair value. So that's the discounted cash flow. Now, what are the big hangups with discounted cash flow analysis this way with spreadsheets? There's a couple things that I think are big hangups with investors. First of all, it's much more important when you're thinking in terms of valuing a company to think about things very simply and make very simple, thoughtful, straightforward assumptions about valuing the company. What I see investors often do is they go down a rabbit hole of complexity, and they create spreadsheets that just have more and more nuance and just more things year by year, to the point where they're looking at margins every single year of the company and what things might happen. And I think it's impossible to look at every possible thing that might happen to a company on a year by year basis to that level of nuance. So I think it's much more important to be straightforward, to have it be simple, to have everything be intentional with it, and to have it be somewhat of a sanity check of what the company's worth. Another thing that I think is important to keep in mind, for some reason as humans, when you see something written down and it has a spreadsheet, a magical spreadsheet, it almost gives you a blanket of confidence. Like, oh, I have it written down there. The company's worth that much. It's just worth 126, so I'm safe buying it at 100. You can't predict the future. Writing down numbers doesn't mean that the future is any more predictable than just saying what you think it's worth based on some assumptions looking at the numbers here. A spreadsheet does not mean that things are going to work out perfectly this way. So you have to keep that in mind. Don't get a false sense of security just because you plug numbers into a spreadsheet. You have to consider so many things about the company that the spreadsheet can't tell you. The first thing is, this number of fair value is reliant, and it presumes that these cash flows, the revenue, and the Ebitda will happen every single year on schedule. If they don't, the company's not worth as much money. For example, if we have a year where we have, let's say, COVID, and the Ebitda of the company drops by 50%, well, that's a problem. Now, luckily that was only for 1 year, but what if that happened for 5 years? That would have been a big problem for the company. The company would have been worth a lot less than investors thought. So things happen outside of what we expect, and a spreadsheet can't tell you about the future. So when you're making these assumptions, just keep in mind, companies are worth their future cash flows. There's other companies, other competitors, other forces of nature trying to affect their cash flows, trying to steal these cash flows. So you have to do a lot of analysis on the moat and the likely probability that this will play out. That's why I'm focusing on companies that I think have very low disruption risk. When I'm doing analysis on MasterCard or S&P Global, railroads, part of the analysis there and thought there is I think there's a high likelihood these cash flows are going to actually materialize. And a lot of other companies, there's companies that the cash flows are very unknown, very unpredictable. You have a stock like this, Uber, it's worth $60 billion. The implied cash flows ahead of this company is tremendous. Will the cash flows materialize? Well, investors don't really know. They think it will, but there's no certainty to it. How are the cash flows going to materialize? What if something else disrupts Uber? What if they never really make money? It's like airlines, right? You just don't know with a lot of companies. So my suggestion is if you're doing discounted cash flow, do it for companies where the cash flows are actually predictable, where the company's likely not going to be disrupted, where it has a wide moat, it has a good business model. If you plug in cash flows of the future 10 years from a company that doesn't have any moat, it's unlikely for those assumptions to happen. So there you have my little rundown of different valuation metrics. Let me know what you think, and if you want me to go into more detail, maybe I could give more examples. I could go over more companies. I'd be happy to go over them. Also, I'll link the spreadsheet in the Discord. I'll link the document as well on PE ratios in the Discord. So hopefully this is helpful. I'll try to do more of these in the future. Thanks for tuning in.